Hey guys, David Robinson here. Welcome to the Apartment Investing Journey. Really excited about our show today. We have a gentleman that's come on that is willing to share a lot about the process that he's been through going from the single family space and investing in a lot of real estate and transitioning into the commercial multifamily space, which I know is a space that a lot of you are in. And so, Sean Tagge, welcome to the show. Appreciate you coming on.
Hey, David, man. Thanks for having me on. I'm thrilled to be here. Hopefully I can help out someone. If not, I'll be happy to talk about myself the whole time. So that's great as well.
Well, that's the whole goal, is to get you to talk a lot about yourself, because you got a lot of experience to share. And I'm excited to have someone with a connection in the Utah world come on the show with me today. So I know you're out in Memphis now, but spent quite a bit of time in Salt Lake. So good to have you.
Yeah, man. Born and raised in Utah. I've been in Memphis for 4 years now, though, and moved for my passion of real estate over here.
Okay, cool. Well, hopefully we'll get into that. Let me share a brief bio about Sean. Sean is graduated in biomedical engineering at the University of Utah. Upon graduating, he worked at the University of Utah Hospital doing research on artificial hearts. And in 2017, he transitioned into his true passion, real estate investing. Today, he's the partner and chief operating officer of Memphis Investment Properties and Southern States Apartment Group. There, he manages the day-to-day operations of acquiring and selling single-family turnkey properties and multifamily syndications. He uses his engineering skills to organize and streamline the systems and processes of the business. He has been involved in over 1,200 single-family real estate transactions and is partner and owner on over 600 doors of multifamily real estate. So really excited about this, because this is a story and a journey that I think a lot of our listeners will relate to, which is, starting out in the single-family space and making a transition. And it sounds like, and we'll find out here in a minute, but it sounds like you're sort of walking the line between the two. And so, Sean, if you don't mind, our podcast is all about the journey. And so we want to back up and hear this story about, here you are in, studying at the University of Utah and working at the hospital. And then all of a sudden you make this big transition into real estate. So maybe take us back to that time in your life.
Yeah. So I literally, I guess in biomedical engineering, I started from the bottom. Literally, I was in the basement of the hospital. So like not a window in sight. I'd have to walk, like 50 feet to go see a window. Doing a lot of data and research, just engineering stuff, a lot of patient data, working under a bunch of physicians. And it was really exciting. I loved what I was doing, helping out humanity with artificial hearts and progressing that medical device industry. But for myself personally, my personality was just fittering under there. I'm a talker. I'm an extrovert by nature. I'm a leader by nature. So I was under other people's directions, all their research studies and ideas. And I also just wanted to retire early, right? I just wanted to find a career path. I just wanted to be 10 steps ahead of where I was. Big dreams of, getting my MBA or getting a PhD. So that was kind of like my considerations, or owning my own business. I grew up in an entrepreneurial family. So I had lots of options ahead of me. With engineering, gave me a lot of options, but I was just kind of discovering my passion down there. And that's kind of what led me to, I was, of course, like a lot of people, I was investing in stocks, thinking about doing options trading, reading up on that, how to retire early. And that's where I landed on Bigger Pockets. And it just led me down the rabbit hole with a great force and drive to just discover real estate investing. And that's luckily when I was purchasing my first house. So I bought a duplex, and that just opened up my eyes, because I was living rent-free, mortgage free. And, let's see, going from there, I just started trying to, so I partnered with some other people on doing flips. I had a local guy over there, and I was just following him around, helping him out, putting a little bit of my money into the flips and helping out with that. And I think for a lot of people, maybe this is what, I kind of approached it methodically, being an engineer. So maybe this suggestion other people could think, and maybe what they're doing, if you're kind of in this position, wanting to get into it and having a great job, but have some higher hopes, is I just really wrote out all of my options. And I did it for probably a year, just going a little bit down each path of the MBA, rising in the corporate ladder, PhD, kind of maybe developing medical devices someday, talk to all the doctors over there, maybe go to med school. Of course, I tried out a little bit of entrepreneurial things, had actually a jewelry business, working with my parents, their farm up in Utah. And then I was also testing out this real estate journey. And you kind of just follow what drives you and what leads you. That I'm a big believer. I'm a believer in God, a higher being, whatever you may be. But it's seriously it just was leading me down real estate. But I had all these other great options and a lot of other friends going different ways. And you're really opposition to the real estate. It was different. But that's really what it was just that. And I think really though, like if I knew better, and I really wish I had this, was a personality test would have been awesome for me to have done. And that's something I'll suggest is take a personality test. There's a lot out there for free, but that really helps you know what would be best for you. And really research and, corporate structure is not for me, So that, but I didn't know that. I've just took a test recently and that helped me. I wish I knew that earlier. So that's where, so I was like, real estate's my thing. So I did a few flips and I bought, then here's how I did. Man, Utah was crazy, super hot market back in 16 even, and 17. Now, it's crazier. And so I looked for some rentals and I couldn't find any in Utah besides that duplex. So that's where I found Memphis, Tennessee. And me being an engineer again, I put on a spreadsheet all these markets and demographics and population growth and rent growth and rent to value ratios and cash flow. I nerded out on several markets and was discovering kind of the Mid-South area. And that's where I actually traveled to Memphis, bought a few rentals while I was working. And that's what really led me here. And then that's how I found how I partnered up with Memphis Investment Properties. My partners were doing well over here, doing a few hundred flips a year. And I kind of just was going to use them for my property management company. And then I don't know how, I just stuck with them, made an impression and became Facebook friends with them and asked them for a few advice and questions, and they just saw I was a go-getter. And then finally came to the point I was asking everyone like, hey, I'm looking to get into real estate full-time. Here's my options, right? What's your advice for me? So I happened to ask one of the partners of Memphis Investment Properties at the time, what's your advice for me? He said, man, if you're serious, because I was like, I'm considering quitting my job, either doing a realtor in Utah or flipping in Utah, or even even considering moving to Memphis to get some more rentals. And he said, look, if you're serious about quitting your job and moving to Memphis, like, come work with us. We need an engineer person. We need someone organized. They're very good salesmen and, making chaos. And we need someone to organize the chaos. So that's really kind of how I ended up moving to Memphis. Yeah.
I got a couple questions about the timeline and the process. This is interesting. So the time that you roughly, what year was it when you bought the duplex?
So in 2015, July.
Okay, cool. So here you are. You're working full time, I'm assuming, when you buy, and this is your first property, regardless. Not you don't even have a single family home at this point, right?
Yeah.
Okay. And so was the plan going in like, hey, you're on Bigger Pockets. You hear about this house hack thing. You're like, I'm going to house hack. Is that how that went down?
The plan was house hack and get up to 10 and just be done for life.
Gotcha. Okay, cool. And so all of a sudden you purchase this duplex and you get this real estate investing bug, right? And then how do you then, not just stay focused on your, profession? What got you into flips and tell us a little bit about that transition into the flipping world.
So local RIA, went to the local RIA, talked to everyone, picked everyone's brains, went to lunch as many people, and then just found affinity to a local flipper who yet again needed help, needed organization and all. And it's like, man, I'm just naturally affinity good to that. Just growing up on managing and making things better. Naturally, that's what I'm good at. Engineer, use the problem solving skills. And so
then you mentioned the move out to Memphis, and was that in roughly 2016? Is that when you made the move out
2017.
there?
So 2016 is when I bought a few out of state. So I bought 3 and partnered up with some people at my local RIA to buy them and partner up with. And I was kind of managing it all, putting some of my capital, mainly had them for all the capital and partnerships. And then, then I moved, then I quit my job 2017. February.
Gotcha.
Yeah.
Okay. So here's the big transition then. Man, and that's a pretty short timeline, right? 2015, you buy your first duplex, you get into flips shortly thereafter, you start buying out of state, in a year later. Mm-hmm. And I'm assuming these are turnkey single family, but
no, these were burrs. These were fix them up and buy them at a discount, get some equity and refi.
Okay. All right, great. So you're buying out of state. And then within basically 2 years now, you make a full-on move out of your corporate career and travel across the country into a completely new environment. So take us to that point in your life when you made that move out there. What was going on? What was the decision around that? And what were the challenges you faced as you moved out there?
Yet again, so for probably, 2015, the bug, and then by mid 2016, it was a complete unquenchable fire of real estate, buying the out of states, and at tail end of 16. So by beginning of 2017, I'm ready. And that kind of quarter four of 16 is when I'm finding this. So yet again, just mapping everything out. So really, really thought of, and I was spending probably 5-10 hours a week just learning and podcasting and talking and everything for, those whole year and a half. The decision was, it's just, I can make so much more doing real estate than even my engineering job. Yes, I'll move up in my engineering job. I got a few promotions, but it's like just controlled by someone else. And it's kind of was disheartening. I'm just like, I am meant for so much more. At least I thought. I just felt it. I want so much more, and I want to get there a lot quicker than crawling the corporate ladder for 10, 20 years. And I wanted my own time, control, and freedom. So that's where I was like, I need to. So I was considering like either starting my own from ground level 0 or being with someone already at level 50 or whatever, but I'm not a whole piece of it, right? I'd be just a junior partner with them. Right. But man, so I considered those pros and cons. And obviously like it might have been, of course, the grass is always greener on each side. But to be honest, I definitely made the right choice doing what I did, because now we've been able to scale up so more. So that's really what it is. Just a lot of talking with the wife, a lot of walks. I talked your ear off about real estate and a lot of prayers and everything. And then really was just really considered the opportunity and just really had a great solid partners to come work with.
And I was going to ask you about that, whether or not you were married, had a family at that point in time, or if it was just you making a move. But it sounds like you're at least married. Did you have any kids at the time?
Just had a 1-year-old daughter. So yeah, man, we were risky, but we did it.
Yeah. So man, this is a big transition, right? So you make the move out to Memphis, you connect with your partners out there, you bring a lot of value to their world. And how did that progress from there?
So it was really fun. Yeah. So we started obviously they already had a great turnkey operation going. I just helped, just organize all their data, their systems, get processes down, help hire people and train them, weekly meetings. So the big key to all of that, the big key to success, I'm holding my book, the book Traction by Gino Wickman. If you're the operations guy, you have to read that like it's your Bible and follow it. That just boosted the business, freed up so much of our time as partners, and our team so much happier and systematized. So that's where
for those that haven't are not familiar with Traction, maybe give us just a very, very high level overview of what Traction is.
Yeah, so they're business consultants. They've consulted tens of thousands of businesses, and then they just wrote down an operations manual of how to run your business, how to keep your team accountable, and have that whole entire growth and vision, and get your traction for your business instead of just spinning your wheels and putting out fires all day.
So it's a guide for operating small business, and large business ultimately.
Small to mid-size, yeah, for sure.
Mm-hmm. Yeah. Okay, cool. So you take Traction as your Bible, and you start implementing all these systems into this business that's sort of growing at that point in time. Take us from there.
Yeah, so just started exponentially growing 240 deals. So 130 and then 240 deals, single families, then 260. And then we just hit 322 single families last year. And then it was 2 years ago. So 2 years in 2019 is when we're like, okay, multifamily, we're ready. Economies of scale, all that great stuff. We started testing out our own capital on a few deals. And that's where we bought Waring Park. It's 2 units right next to each other, 99 units. They're street away from each other, 60 units on one and then 39 on the other. And so we're going to test out our capital on some of our own deals before we go and risk other people's capital. So we invested it. We all put a little pro rata share in. And then about a year after that, in 2019, we syndicated our first 2 deals, 124 unit and 128 units. And then this year we've syndicated a 184 unit and a 74 unit. So we're rolling.
And this is awesome. So, and all of these properties located in the Memphis market?
Yes, in the Memphis market. And what's nice is that we're selling our single families. What was nice for us is like a lot of people, they're kind of scared on the money raise. For us, that was actually probably our strength because we had a whole list of hundreds of investors, thousands of investors buying single family homes from us, turnkey single family homes. And so a lot of them just were selling their houses and they were just 1031 or moving up into a part of our apartments with us. So that part was actually really nice. And really the difficult part for us was just, the docs and the, 506B and C. Right. So we used Gene Trowbridge. It's a whole new business book, and used his syndication attorney services. That really helped us out. And then, just created some more financial models and all that. And that's really what took us apart. And then kind of really just watching the data on our current deals, just to make sure we could prove the theory with our own capital first before raising others.
So I want to break down a couple aspects of this. But first, let's talk about this sort of secret weapon that you have and had that you maybe didn't realize at that moment in time, but was this database of investors, right? Mm-hmm. And a lot of those that are wanting to scale beyond their own financial capacity to acquire property, eventually everybody runs out of money, right? And the next step, if you want to keep growing and keep acquiring property, is that you have to be able to bring other investors to the table. So talk to us a little bit about, previously you have been explaining to investors the power of turnkey single family rentals. And then all of a sudden you flip and it's like, hey, multifamily over here. Talk to us about maybe the opportunity and the challenges and how those conversations went with your investor network about moving from single family turnkey. And did you say, hey, this is a better option? Or did you say this is an alternative? What was that conversation like with your investor network?
Great question. So first off, a few of them were already doing syndications with other people. And we're like, well, I mean, God, we're better than they trust us a bunch. We have great years with them. There's that. So really just talking, listening to them, hearing what they're saying. They've guided us. Our investors have actually guided us so many different ways of improving. So always, and that's in traction and in the E-Myth, is just always listen to your customers, your clients. Always hear a complaint or a concern, or even like asking for anything. Just treat that as like, man, how can we be proactive here? So doing that, writing down a lot of that. And then in terms of doing it, really what it is some investors, they only have enough for a single family and aren't accredited, and they want to own it all 100% themselves and want to do all that work and have that equity. Great. Turnkey is for you. Then though there were just some investors like, man, the turnkeys are actually taking up a little bit of time for me. Not a lot, but you guys make it pretty good, but I still have to pay the mortgage and do the insurance and all that. And, close on the deal and turn in all my docs, and they have to personally guarantee it. And they're just having so much capital. It's getting hard for us to supply all of our investors with houses. Like even now today, we have 10 buyers for every one house we're selling. We're selling 300-400 a year. So then it's just natural. Like, well, they have all this money and we can't meet their appetite. So then we basically just market it. We just go, okay, we just go straight up like, here's turnkey. And you know what? You own 100% of it. You actually probably might get a better IRR on that. But if you're time constrained and want to utilize us and partner with us and not be personally guaranteed on loans, there's this. Yes, we're taking a whatever split it may be, depending on the deal, but there's a lot less of this to you. So we just basically just laid out the options for them so they can make a pretty dang good informed decision of what they'd want to do. And there's just out of 1,000 people, some are one way, some are the other. So that's kind of how we did it.
And I know that there's some listeners that are probably thinking, okay, well, what does the return profile look like with a turnkey out in Memphis versus a syndication opportunity out in Memphis? Have you broken that down at all? Can you give us some general guidance on what someone should expect?
So of course, this is real estate. Everything's crazy and changes at the, nick of a dime, and consult your own, counselors, CPAs, all that, financial advisors. But from me, what I've personally seen, I've done both and seen both a lot. So a turnkey, you're buying it at market value. But there's still the appreciation, the rent growth, and more, you have homeowners appreciating the area sometimes too as well, if it's an A or B class. So, and you own 100% of it. You're not splitting a 70-30 or a 50-50 split after some IRR hurdle. So it's all 100% yours. Typically, they're getting a 6 to 10% cash on cash of their 20% down investment plus some closing costs. Then depending on if they sell in 5 to 10 years, if you include all the appreciation, mortgage principal pay down, all of that, they're hitting the 20 to 30% plus IRR. Me personally, on a Burr one I've done here in Memphis, I got a 45% IRR. Now that one I had a little bit of equity day one, but not a whole lot compared to Turnkey, and a lot more work because I had to virtually manage my 3. I just exited one. So compared to a Burr, it's about a third less as efficient, but man, I mean, time-wise, it's way less.
Yeah.
Then obviously like multifamilies, of course, those are all different, but you've seen a lot of other syndicators, what they're doing. They're projecting 15% IRRs and probably hitting in the 20s, mid 20s, low 20s on the IRRs, 6-7 pref, 70-30 split typically, whatever they see. Yeah.
I mean, you're definitely taking a haircut on investing in a syndication out there versus going with a turnkey, but there is a level of involvement required on the turnkey and responsibility on the turnkey that isn't there on the syndication, and liability, I would say as well.
Liability. You're personally guaranteeing the turnkeys. You're not on the general partners guarantee the syndications. Then also your capital strained. You can only buy so many turnkeys from us a year. It's competitive, so they're getting priced up a bit. Mm-hmm. Where the multifamily, you can do one wire and have $1 million in it, right?
Yeah. And so I'm interested then, before we transition to another conversation here, but I'm curious about, as you're listening to your investors, as they've experienced both the turnkey and the single family, do you have a sense of your investor network and what they prefer? Or is it across the board?
Across the board. Across the board. Some people do both. Some people do just one, and that's it. That's all I want. And even in the turnkey, there's A-class neighborhoods, B and C. And some will stick to just one. And then a lot though are kind of, just like me, they're moving up. Some are selling or exiting and moving up into multifamily, keeping a few rentals. It's everywhere in between, just on their journey and where they're at. And we just accommodate to both and have a big enough list that we got plenty of appetite on both ends.
Yeah, that's great. Well, congratulations on the success in that transition into the multifamily space. I'm curious, you sort of have this gap between the single family and then a big going into large commercial multifamily. Have you toyed at all with implementing sort of the single family turnkey mindset on smaller multifamily, small commercial multifamily? Let's, call it 4 to, 12 to 20 units.
Very interesting question. Insightful question there. So we have toyed with that. My partners, Jim, Reedy, Brad Reed, they've been in Memphis for 30 plus years. So number one, that's also a very strategic partnership, win-win there on both sides. They have a great industry knowledge. So Jim's bought lots of the 12, the sub 50 unit apartments in Memphis for him. And he's bought their C class. So they're a little bit tougher to manage. You really want 100 plus units for the economies of scale and really the on-site full-time manager there policing it like a guard dog. And over where these 12 sub 12s and typically the 12 units ish 20, they're in the C class areas. There's a few in the A class areas, which might be easier to manage. You might need an on-site manager there to police it. But here in Memphis, just us knowing the market, that's why we have, and that's why we've now gone to 100 plus with the C class. It's just the management's a little trickier. You need someone there policing it.
Gotcha.
Us, in our opinion, so we haven't been able to do the turnkey multifamilies and really just also we 2 systems. We want to keep it already is complex enough where we're at. So we want to just keep the systems rolling where we're at, potentially something in the future. We do get, and you're right, man. I love you asking that because we do get a lot of people right in the middle wanting to do their own kind of turnkey or maybe a burr on an apartment, and we help out. And we've toyed with it. We've actually done it with a few investors. What's also when we do it with the investors, they just don't have the same strategy as us and don't upkeep it as much as we would want to manage it for them. And so it just, the interest didn't align, and we had to let go of management because we were just like, this needs a $5,000 renovation for us to get the rent you're asking. So that's what we've seen. And it's only been a few. So don't take that as the law there. That's just our experience.
Yeah. Love it. All right. So I want to transition a little bit here in the time that we have remaining. And I want to talk about this 99 unit deal out in Memphis. And this is your 2 properties, from my understanding, 50 Correct. Units and 49 units. And this is your first foray into commercial multifamily, correct?
Yeah, correct. This is us we're like, hey guys, we want to do this syndications back in 19, but look, let's, be good stewards. Let's first mess up our money on a deal, and before we go and raise other people. So we got all of our partnership, us, and one of our key salesmen, we raised it and all ourselves to just, mess up our own money if we were going to. We didn't, obviously we're not in the game of doing that, but we want to try it out.
Yeah.
So yeah, we went and bought it in March of 19, and the other 40 units, June of 19. They're awesome. They're like 5 units from our office. Oh yeah, my partner, we have an in-house property management company. We manage 3,000 doors that my partners own, Reedy and Company Realtors. So, I mean, it's vertically integrated. I literally, the property manager comes in the office and we can chat with her every day and watch her like a guard, over her and then helping her out. And yeah, we purchased it for 3.6 million, both of them combined. All these numbers are combined.
Okay.
The reno was 1.8 million. So extremely distressed. That's like 20 plus thousand a door.
Yeah.
Extremely Capex distressed. And it was about 50% occupied at purchase. Not very well managed. Rents $200 to $150 under market value. It was just a great opportunity.
How did you find it? How did you source the deal?
Great question. A broker that my partner Jim Reedy's known for years, and actually he mentored him when he's getting started out in the space, and that broker's moved up into one of the top multifamily people here. So There's that,
Yeah.
And he just said, yeah, this owner's looking to sell, and ran it by us, and we offered with other people, but obviously we had the best track record and ability to close.
Gotcha. Okay. So $3.6 million purchase, $1.8 million in CapEx. What was that CapEx going to consist of? Obviously around $20,000 per unit, but what did that consist of?
Yeah. So that was interior renovations, flooring, LVP, sometimes each unit, every unit was different. Some that were occupied didn't need as much work. Some though, a few of the units were burnt down or mold and needed all that, and electrical and plumbing permits. So kind of a mix in between the units, $5,000 to $15,000 on the interiors. Then the exterior, like 10, $5 to $10,000 for the exterior on average. Trees, repave the parking lot. There's a big gaping hole in the parking lot in one area, so repave that section. It's 2 stories, so a lot of the iron railing to get up had to be fixed. Painting the brick exterior, lots of landscaping. Roofs. Yep. A lot of the roofs needed to be replaced. A lot of the HVACs, water heaters. I mean, we put washer and dryer units in there, which helped extremely raise the rents there. So the plumbing and electrical for that sometimes. So it was a big rent, which is what sets us apart from other, syndicators here, is that we have a renovation. I mean, we're doing $40,000 renos on single family turnkeys, 25. So it's a walk in the park for us when they're all right next to each other.
And did you find that working on, 90 units roughly, that you were able to achieve some efficiencies by working on a project like that versus doing your single family turnkey renos?
Oh yeah, huge, big time. So my partner Jim Reedy, his passion is renovations, and yeah, he hired some crews to really rock this out, and just been rolling them through our other syndications too. So it's been a really good stars aligning with keeping them working the whole time. And yeah, big economies of scale on all of that end. And since we had the turnkey operation in the whole warehouse anyways here, 8,000 square feet in our office, we were buying the HVACs and the water heaters all at a bulk discount. And that even gave us even more purchasing power and competitive edge when, getting quotes for materials. And
so you've got, again, just to reiterate, $3.6 million purchase, 1.8 in CapEx. You found this deal through a broker relationship. Roughly 50% of the units were occupied. Is that correct?
Correct.
Wow, goodness.
Yeah.
Okay. And so, what does that deal look like today? Where does it stand today?
Okay. So it was in Berkeley, and it actually got like the sign, the best of Berkeley for a month, like the best, I don't know, of the area. Got a nice award because we painted the brick. It's looking sweet. The puppy is running like a well-oiled machine, because everything's new. So very few maintenance requests. It is 98% plus occupied. We had a month where it's 100, it dips up and down, and we try to pre-lease it pretty early on. and 98% plus collections. So we turned this sucker around, raised rents from average 600 a month up to 750. So some of the large units are renting for 825, the smaller in the 750 range, 700. And man, it surprised me. I was a little scared going in, but we definitely hit it and nailed it out of the ballpark. So we actually have it to sell. And interesting enough, recording today, it is closing today. Signed all the docs and everything this morning. We're selling it for 8.25 million.
Woo!
So yeah, it is our home run, the best deal any of us have ever done, largest and best. And we're gonna announce, but we're gonna hit a 55% plus IRR. We had a 1.75 million of our own capital raise. Got the 75% loan to cost loan. So 1.75 million, we turned to 55% IRR, which is I wrote this down. I got it somewhere. Let's see. It is a 2.43 equity multiple in 2.3 years. So,
well, I don't think you're going to complain about that at all. So the question then becomes, right? Why not do more of that instead of the turnkey? Or maybe you're getting comparable returns on the turnkey, and maybe that's just a little bit different business model. But I'm interested on your thoughts. Why not turn as much of your attention as you can to that?
Okay. Traction. We got the turnkey on a well-oiled machine.
Yeah.
Of course, I work in the business, but I'm working on the business, and we got the team and delegate and process where it's running pretty dang well. Of course, I'm not going to leave it. I'm going to watch it 10, 20, 30, 40 hours a week. But now it's giving me freer time to go focus on these multifamilies. And I'm trying to apply the same processes and data and metrics tracking weekly and scorecards with the property managers to get this rolling. And that's why, so 2019, we bought that. In 2020, that's why we saw the numbers were so good already. So that's why we raised 2 in 2019 and we've done 2 this year. But right now it's, the challenges of the other people is finding deals, and that's the hard inventory.
Yeah, for sure. Well, congratulations on just a killer deal, especially on your first foray into the multifamily space. And it goes to show that, you guys know your market there. You have partners that have a tremendous amount of experience in the real estate space. You bringing the operational capacity to the business and really structuring things that way. So congratulations to you guys. I've taken most of the time that we had booked out. And so I want to start winding down here and be respectful of your hard stop. But I've got 3 final questions for you as we do wind down. The first one is, what's the biggest mistake that you've made on your apartment investing journey that we could all learn from?
Okay. We learned with our own money. We underestimated the renovation on the property we just had. Luckily, the rents and everything, the market, helped out. And we had good numbers anyways at buying it. So definitely need reserves and overinflate your renovation budget, especially when it's a 15, 10 plus, 20 plus projected renovation. If it's just a clean scrape, it's easier to be on track with that budget versus a large, heavy value add, extremely distressed asset. So we put that into our other deals. I suggest a 3 to 5% of the purchase price in just reserves, not above and beyond the budget. And then if you're, scaling, it's a scaling percentage, but I'd raise your budget amount 10, 20%. Scaling the higher percentage for the higher type of rental budget you have. So we're scaling our budgets 10, 20% above and beyond what we conservatively think is the budget. So that's what we're doing to correct that. And I suggest that for any newbie, especially if it's a heavy value add.
Love it. Love it.
Yes.
What's the biggest win you've had on your investing journey so far?
We just said it, man, the 55% IRR, that's of course our own personal capital. We proved the theory, really. The big win, yes, the return's great, but really, even if it was a decent IRR, it's just we proved the theory. We walked through every step, start to finish, on that apartment, and excellent execution. Our partners were, our unity, and we're just loving it all. And the sky's the limit, hopefully. And we're just super grateful for that.
Cool. Last question I've got for you: what's the best advice you have for someone who's just starting their apartment investing journey?
You go back to my story and do all those things. Get a partner. If you can do it on your own. If that's if that's your personality and you need to have control of everything, that's you. If you're a good team worker and love batting ideas off each other, and you have strengths and weaknesses and you need someone to fill that in, then I suggest get a partner. So I think know thyself is what I'm saying. Take a personality test, 16personalities.com. Ray Dalio has a personality test. Read over a few, figure out yourself, figure out your strengths and weaknesses, and then bring that to someone else. And then traction, read books, listen to podcasts, talk to people. There's my advice.
Love it. Love it. Well, Sean, you've got an incredible journey thus far, and I believe just getting started. Thanks for taking some time to walk us through your experience, share some insight with us, and help our listeners on their journey. And I look forward to connecting with you again soon.
Yeah, thank you so much, David, and thank you so much, everyone, for listening. Appreciate it.
And Sean, what's the best way for our listeners to connect with you if they want to just learn more about what you have going on or connect with you and potentially invest in one of your opportunities in the future?
Our website, memphisinvestmentproperties.net. You can connect on there. You can send me, you can call me 901-500-7517 or email me, Sean@memphisinvestmentproperties.net. Check out our YouTube channel, Memphis Investment Properties. Please subscribe and like to it. I put out some stuff. I have these deals and case studies and trainings, and appreciate everything from there and all the love you guys are giving us there as well.
Okay, awesome. We'll have that info in the show notes. If you're listening right now, go down, click on one of those links, connect with Sean and his team. And Sean, again, thanks for your time, and we'll connect again soon.
Thank you so much, David.